What are the main cost drivers for products in a bank? It's a question I get asked quite often, but I have those questions myself as well. It's a ongoing quest, but I'll try to give you an update on my little bit of knowledge so far. That's mainly now in the retail lending sector, which is of course a large part of retail banking. And the main cost drivers can be actually broken down into three areas. One, expected losses. Two, is cost of funding. And three is the operational cost. And I'll start with the third one. The third one, the operational cost, is also the area where I feel most comfortable with because that's the area where I've spent most of my career trying to model operational cost in organizations and especially in banking situations. And these costs are being modeled in different ways that can be very granular or not so granular, can be made capacity aware or not capacity aware, multidimensional or single dimensional. So there are a lot of different elements into that. I have some videos and some articles on that. But you see more and more banks trying to get as granular as possible, even on a transactional basis, capturing the operational cost. And I really advocate for that. Then the expected losses. Logically, the expected losses, they make up a large part of the whole lending business because any loan you can recover is a cost. And there have been a lot of different models going around on trying to calculate the expected losses, but those are mainly driven by the risk departments. And that actually brings up an interesting question, is that where does the profitability of a bank is being managed? And you see that actually all over the place. I mean, I'm always trying to contact people that will manage the profitability of a certain product or a certain situation in a certain place in the bank. And it's difficult to find them to pinpoint down where they are because it differs per bank. The only thing that doesn't differ is who is actually providing the data. And providing the data for expected loss is always coming from the risk department. And providing the data for the second big chunk, which is the cost of funding, always comes from treasury. So those are the two departments that are very clear defined. The operational cost, however, it's sometimes at the finance department, it's sometimes more on the commercial side of things, it's sometimes they have an operations department, it's always some type of controller, financial controller, business controller, and usually those are also the ones who are actually gathering all those information, are gathering the information from treasury and from risk. And the interesting part also is, if you look at those three main cost items, cost of funding, expected loss, and operational cost, they have sort of a different rhythm to it. I mean, the cost of funding is something that changes like every day or even every hour. The operational cost side of things, that usually changes once a month, maybe even once a quarter, that you want to look back and see what difference you have. Whereas the expected loss are models that are always run as well. And I'm not completely sure, but I think at least once a month that they are being looked at. So there's a different element to it. And depending on where you want to look at profitability, whether it's for setting pricing for today or for tomorrow, you could run it as often as, I don't know, 3, 4, 5 times a day. Or I met somebody who told me, oh, I just run it 4 times the last hour. But for a profitability model that you want to use to actually come up to how is the bottom line of the bank comprised, that's something that you would probably run only once a month. That's what I see going by with most of the clients that I speak to. So yeah, so three different cost items, and these cost items have a different suppliers and also different granularity or different timing to it. So yeah, that's something that I'd like to share.